It's not just the U.S. and China raising flags about the risk of deflation. The strength of the euro, along with years of ultra-low inflation in the currency bloc, prompted European Central Bank President Mario Draghi to announce that the bank is taking measures right now to fight possible widespread price and wage declines that could send the entire eurozone sliding into deflation.
Nick Colas says investors should brace themselves for more volatility. He's chief market strategist at Convergex. So, Nick, you heard all of these reasons for what was going on in the markets today. What concerns you the most? And is this the beginning of a correction?
Well, certainly the problems we're having in the Ukraine with Russia were top of mind today because while the economic data was very sloppy out of China, it was better in the U.S. The sell-off really came as the issue in Ukraine began to come to the fore. As far as the beginning of a correction, I do see a lot more volatility for U.S. stocks this year. We're coming off a long period of very low volatility, but I don't see the creation of the fundamentals for, say, a 10% decline. I think we're going to be stuck in more of a 3 to 5% decline.
Is deflation a worry of yours, Nick?
It absolutely has been for a number of years. Slow economic growth around the world, combined with the deflation that China exports, has made monetary policy very difficult. And the nightmare scenario for most policymakers that we don't want to become Japan, which has had 10 years of deflation and is still trying to work through those problems. So it's certainly a concern.
We always hear about inflation worries, especially from the Federal Reserve, and now we're talking about deflation in Europe and in China. I mean, to what extent can that impact the U.S. economy?
You know, deflation's a funny thing because you would think that lower prices would encourage consumers to buy. But in fact, the opposite is true. And the reason policymakers worry about it is because it can really slow down a recovery. Bottom line is that it's a big concern for the Fed. And that's why they've been so easy with low interest rates and a lot of money printing over the past couple of years, because they really dread the notion of becoming Japan.
More volatility, possible deflation, Nick, on the screen. Yet you think the market will end higher this year. How do you get there?
Yeah, I tell you, the anchor that we use to understand the stock market is corporate earnings. And the bottom line is U.S. companies have done a fantastic job generating very strong levels of earnings in a very lackluster global recovery and even a lackluster U.S. recovery. So ultimately, our confidence comes from the fact that U.S. companies can continue to make very good profits, even in a slow growth and somewhat troubled global economy.
So, Nick, you always talk about diversification and why that's important for investors. So as you look around the globe, is the U.S. the place to be in a portfolio, or should you have stocks in other international markets? And also, what about gold?
Yeah, the bottom line on diversification is, of course, it's very important to have both bonds and stocks in a portfolio. You've seen that this year. The stock market is flat on the year. The aggregate bond index is up 1.5%, so that's very important. The U.S., we think, is the best place to be. If you look at Europe, for example, Russia's a huge exporter of oil. It's the missing piece of this equation. Germany takes 9% of all of Russian oil production. So the European economy is going to be very, very troubled as we go through the problems in the Ukraine. As far as gold goes, I think it's a very efficient way to help diversify a portfolio, and we believe a 3 to 5% weighting in a portfolio is an appropriate amount of gold for a standard diversified portfolio.
Okay, so much good information. Nick, thanks so much.
Thank you.
Nick Colas, Chief Market Strategist at Convergex.